Hello, everyone. Today we are presenting a video representation of the book Unusual Billionaires. This presentation has been put together by me along with my team. Ishika Buhara, Navya Rajput, Mehul Sharma, Altaf Mansoori, Burhanuddin Solanki, Prasang Dugar, and myself, Ratan Thakur. Together, we will walk through the key ideas behind long-term wealth creation in Indian businesses. Next slide, please. This book comes from the work of Saurabh Mukherjea, who has spent years closely studying Indian companies and how wealth is actually built over long periods of time. His focus has never been on predicting the next big trend or market movement. Instead, he looks for patterns, what works consistently, what fails repeatedly, and why only small set of promoters manage to build wealth that lasts for decades. So, Unusual Billionaires is not theory heavy. It is based on real businesses, real decisions, and long term evidence from the Indian market. Next slide, please. The quality is to be great. When we hear the word billionaire, we usually think of bold risks, aggressive growth, and dramatic success stories. But this book starts with a very different idea. It is not about people who got lucky once, it is about people who stayed successful quietly for a very long time. One of the first lessons is that wealth creation is usually not exciting. It is slow, steady, and driven by discipline. The promoters studied here were not chasing new opportunities every few years. They focused on doing a few simple things right again and again over long periods. A clear pattern stands out. They cared more about not making big mistakes than about doing something extraordinary. They avoided unnecessary debt, they did not rush into aggressive expansion, and they did not change direction every time market conditions change. That is also why many of these businesses look boring from the outside. They operate in stable industries, focus on execution, and value consistency over speed. The message here is very simple. Big wealth does not come from big risks. It comes from patience, discipline, and staying in the game. Next slide, please. Indian market context. This approach becomes even more important when we look at the Indian market. India is largely promoter driven market. Here, who runs the company matters just as much what the company does. Over time, the promoter's mindset shows up everywhere in how money is invested, in how risks are taken, and how shareholders are treated. External protection for investors is not always strong. So, integrity and discipline are not optional. They are essential. There is also a strong lesson on patience. India offers long term growth, but it rarely rewards hurry. The promoters who succeeded did not try to grow too fast. They stayed invested through ups and downs. They invested carefully and avoided decisions that could weaken the business during difficult phases. So, as we move forward, keep this lens in mind. This is not a book about excitement, it is a book about staying in power. Not about quick wins, but about building wealth slowly, steadily, and sensibly over many years. That is what makes this billionaires truly usual. Over to Prasad.
So the first topic is framework discipline. As the word indicates, framework means a structured way of taking decisions. So here, promoters don't take decisions rely on brilliance, luck, or forecast, but they take decisions on figures and measures. So there are three main pillars. First, rule-based decision making. Here, promoters take decisions well in advance before any crisis. Because if you take example like projections, any plant, they take decisions before any crisis. So first is core business. Companies like Budget Paints, Marico stay within what they understood best and avoid diversification. So second, avoid stories and narratives. Here, promoters are not taking any stories and narratives because they just rely on the company's performance. If I take example of Asian Paints, so Asian Paints, if there is a real estate booms, so they don't take decisions on that, but they take decisions that the company they output, like working capital. Third, measures everything: ROCE, cash flows, and balance sheet strength. ROCE simply measures the value of the growth, means high ROCE means good business. Cash flows indicates the quality of the reported profits. Balance sheet indicates the survival of business. So the compounding here comes by the real ROCEs, good cash flows, and balance sheet. So the next topic is management quality and governance. Management quality means Management quality means well governance and how it fairly responsible for the benefits of shareholders. So here there are three pillars: conservative accounting practices. Conservative accounting practices means how profits earned until they have been safely earned, and recognizing cost and debt before they are hiding. So here promoters don't show off their profits in order to earn respect. So here investors will not satisfy with this fake profits in order to get good returns. Second, integrity or aggressive growth. Here promoters believe integrity or aggressive, because aggressive means you are expanding your business aggressively in order to take high margins, but aggressive growth eventually disaster their margins and growth. So integrity means well doing things even after people slows you down. Third, promoters align with minority shareholders. Here's promoters' value is uh, respectively aligned with the shareholder company's value. If the company's value is up, then promoters' value up. So promoters are the real assets. They think minority shareholders and company as a valuable asset, not just an ATM for their money. So third is strategic discipline, avoiding extremes and value destructive growth. So here promoters saying that even after taking many expansions, extremes growth will eventually lead to low efficiency and disaster of business. So here are four main pillars. First, rejection of extreme growth and over expansions. So many promoters think long-term businesses fails because they eventually take over expansion to factories, product lines, and many others that they don't know extreme growth strains management bandwidth, supply chains, and capital efficiency. So over expansions eventually destroys the ROCEs and the product lines. Second, acceptance of mean reversion in margins. High margins means high profits. So promoters think that margins today will not be stay forever in for decade. So we need to identify and take decisions that if margins fall, we are ready. Avoidance of hot cycles and empire building. Many sectors are built for the fashionables and big empires to just show off and status. So, unusual billionaires promoters think that taking actions in hot sectors will not just possible because your core strength, your core business will not be here. Avoidance of debt flood growth and acquisitions. Good promoters think that more debt will create stress because companies taking more debt will have to give interest and principal amount in debt. So here takeaway is that you need to set rules, you need to set measures that will create your business grow. So for more learnings, I will hand over to this Burhanuddin Solanki.
Hello everyone. This slide shows the philosophy of capital allocation. The central idea of capital allocation is how the company uses its money to create long-term value. They allocate capital for the following reasons. First, they reinvest significant portions of profit back into the core business to drive sustainable growth. Second, they invest in backward and forward integration to get better margins, profits, and availability of raw materials. Third, they may also invest to expand business internationally. Fourth, they also invest in day-to-day operations to improve efficiency. Finally, they also give a reasonable amount of profits as dividend to the shareholders. On the right side, you can see two charts. First shows the sources of capital presented on the equity side of the balance sheet. Second shows application of capital presented on the asset side of the balance sheet, in which you can see capex, which shows how much percentage of profits have been reinvested in the business. So moving to the next slide, that is innovation from IBAS framework by John Kay, which means to create something new. Next slide, please. I To stand out among the crowd, the thing you need is innovation. I have divided innovation into various aspects, namely technology, product, stakeholders, packaging and advertisement, and other. For example, Asian Paints have used technological innovations, like it has highly invested in information technology and uses computers to forecast demand. Berger Paints have used product innovation, like it has developed designer finished paints, which looks like marble. Mexico organizes sports and cultural competition for their workers, which is an example for innovation related to stakeholders. Marigo have transitioned from tin cans to plastic packaging of parachute oil bottles. And Australia have advertised on news channels during general elections of 2004, which shows the example of innovation related to packaging and advertisement. Examples of other innovations includes merger pens, installing color tinting machine at dealer shops. Asian Paints have created a truly independent board of directors, etc. You can see various strategies on your screen. But with innovation, the company also needs to create its presence in the market. So moving to the next slide, that is brand and reputation. Brand and reputation means how a company is perceived by its stakeholders and the market. It is the function of loyalty, quality, trust, and reliability. For example, most of the dealers choose Asian Paints due to their loyalty and long-term relationship. Esther Limited creates the latest and best quality pipes. Consumers trust Marico for healthy and safe oil. Axis Bank provides reliability for financial transactions, services, and digital banking. Companies also use celebrities to gain trust and emotions to connect to people. For example, HDFC Bank have used Kapil Sharma and Shah Rukh Khan. They also have specialized logos which conveys their message and brand. For example, Asian Paints. So this is how the company creates its presence in the market. That's all from my side, handing it over to Isika.
Hello everyone. Now let us have a look at the third criteria of IBAS framework, namely architecture. It answers a very simple question: how is the company built beneath its surface? It's not just about the factory size, but about the quality of relationship that the firm creates with its key stakeholders over a long period of time. With customers, these firms go beyond transactions. They invest in understanding their demand, but also their behavior. For example, installing of tinting machines was not just about selling more paint, it was about personalization, precision, and locking in customers' loyalty. With employers, the relationship is not built on family like slogans, but performance like incentives, clarity of roles, and dignity of work. When employees feel trusted and motivated, they don't just comply, but they commit. This type of psychological mindset cannot be easily replicated by the competitors in the market. With suppliers, unusual billionaires don't negotiate only for the lowest price, they build the relationship on the mutual dependence. Predictable payments and long-term contracts encourages the suppliers to prioritize quality and innovation for the firm. A classic example of this is Page Industries, where vendors grow with the company and not just around them. And finally comes the relationship with the society and the regulators. Ethical governance and fair disclosures of the financial statements reduces the friction cost, lawsuits, compliance barriers, and reputational damages. Can we come to the next slide, please? Now let us look at the fourth criteria of IBS framework, namely strategic assets. It refers to those assets of the company which cannot be easily replicated by the competitors. Tangible assets such as advanced plans, logistic systems, and proprietary technology matters to the company, but they only tell us how the company is operating at the current level. The real power lies in intangible assets. Brand equity compresses your marketing cost. Management credibility lowers the cost of capital as the investors in the market do respect and view the management decisions precisely. Deep customer trust ensures repeated sales even during downturns. Culture drives execution quality without management supervisions. These assets are built slowly through thousands of right decisions being taken by the company consistently. They cannot be purchased or reverse engineered from financial statements, and that is why they sustain competitive advantage much longer than the physical assets of the company. Can we come to the next slide, please? Balance sheet discipline. It is a place where psychology meet numbers. Unusual billionaires do not manage it for the next quarter, but for the next crisis. They avoid unnecessary leverage, allocate their capital thoughtfully, and exit the business when the returns deteriorates, even if it is emotionally difficult for the company to do so. Companies like Asian Paints, Marico, and Astral Poly demonstrate their growth with disciplined compounds, while growth with aggressive expansion just reduces your value. Debt is seen not only as the enemy or a fuel, but just as a precision tool which is used only when it has the ability to give returns to the shareholders and bring resilience to the organization. A strong balance sheet turns downturns into execution opportunities and ensures the continuity of the business when the competitors are forced to retreat. In simple words, they design the balance sheet to survive the bad years and not just to impress the market in good years. That's all from my side. Handing it over to Navya Rajput.
So here, Mr. Saurabh Mukherjea identifies different sectorial patterns that distinguishes these firms from 1,000 listed firms in Indian Stock Exchange. First is consumer goods and FMCG products. Marico transformed from commodity trading to leading branded products like Parachute and Saffola. Asian Paints and Berger Paints dominate the decorative paint segment with powerful brands and distribution networks. Page Industries premium brand apparel jockey in India. These sectors benefit consistent demand and brand loyalty and pricing power. Next is financial services. HDFC Bank and Axis Bank showcases how disciplined banking and a customer-centric model can deliver sustained growth and strong returns. Next is manufacturing and infrastructure. Astral Polytechnic illustrates success in industrial manufacturing, particularly plumbing solutions, by innovating products and expanding markets. Despite despite sector differences, all companies meet two criteria that are 10% revenue growth and every year and more than 15% return on capital employed over extended periods. Next slide. Next slide. So here, Mr. Mukherjee highlighted distinct promoter behaviors that contribute to long-term success. First one is long-term focus. Promoters avoid short-term gains. They emphasize sustainable growth, not quick profits, but strategic patience is a central theme. Next is core business discipline. These leaders stay rooted in their core domain and avoid unrelated diversification. For example, Asian Paints stuck to paints rather than diversifying excessively. Next is deepening competitive moats. Promoters invest continuously to strengthen competitive advantages through technology, branding, distribution efficiency, and customer loyalty. Next is prudent capital allocation. Instead of aggressive acquisitions or risky ventures, these companies allocate capital sensibly, reinvesting in business or returning it to shareholders. Next is professional management and governance. Many promoters willingly bought in experienced executives and professional boards to scale the business while maintaining governance standards. This balance between visionary leadership and managerial expertise is a key. Now, the last one is innovation driven culture. Whether it's Asian Paints adopting tech for supply chain efficiency or Page Industries product innovation, promoters encourage innovation to stay ahead of competition. These themes are sector agnostic, whether in FMCG, banking, or manufacturing. The approach remains the same. Handing it over to Vivan.
So I'll be talking about growth combined with returns. So one of the most important ideas in Unusual Billionaires is that growth alone is not enough. What really matters is growth combined with high ROCE, which is returns on capital. So high and stable ROCE is non-negotiable. What the book highlights is that great companies don't just have one or two good years, but they sustain high ROCE for decades across different economic cycles. For example, Asian Paints is mentioned because it consistently maintains strong returns through pricing discipline and a capital light model. This stability tells us something very important. The business has real quality and control over its economics. The book also warns us about whom to trust and whom not to. So one time spike in ROCE is never trustable. Anyone can have a one good year, but only few companies can repeat it for 10, 20, or 30 years. Coming to growth without ROCE destroys value. Now, the second point is equally important. The book actually warns us about companies that grow without protecting returns. If a company expands capacity, enters new market, or take more loans, but earns lower ROCE on that new capital, then over time shareholder value gets diluted. HDFC Bank is a good example of doing this the right way. It grows its loan book, but it also manages and maintains return discipline. So growth adds value instead of destroying it. The key message here is growth is valuable only when the new capital earns returns similar or equal to the older capital. ROCE signals pricing powers and competitive advantage. High ROCE also tells us something deeper about the business. It shows us that the company has pricing power. That means it can raise prices without losing customers. It also shows distribution efficiency, good working capital management, and often a strong brand or market position. For example, Page Industries shows a strong ROCE because of brand-led pricing and efficient distribution. When a company can generate high ROCE consistently, it usually means competitors find it hard to challenge them. Moving on to the next slide. So now that we understand why return matters, let's look at how these companies achieve long-term success. One of the most powerful ideas in this book is consistency over brilliance. So, steady earnings growth over volatility. This book defines greatness as doing well for decades, not just for one good phase. So, it clearly rejects the idea of short term brilliance. In fact, only 0.2% of Indian listed companies show this kind of long term consistency. The companies studied in this book, FAE companies, which is focused, allocative, and efficient, did not rely on sudden spikes in earnings. They delivered steady earnings growth year after year. Coming to avoids boom bust cycles. Another key learning is that these businesses avoid boom bust cycles. They stay away from highly cyclical sectors where profits depend highly on macro conditions like commodities. Instead, they focus on consumer and financial franchises that they can survive downturns. For example, companies like Berger Paints and Page Industries maintain profitability even during tough periods. They protected their balance sheets and avoided big collapses. Coming to predictability valued more than peak performance. So the final point here is predictability. The book shows that market reward companies whose future cash flows are easier to forecast even if growth looks modest. Why? Because earnings reduce risk. A company that delivers steady performance often get higher valuation multiples than a company that has blockbuster year and then struggles. Coming to the main point of the theme. So it's not about chasing the fastest growth. It's about building businesses that grow consistently, earn high returns, and survive for decades. That's how unusual billionaires are created. Handing it over to Mehul.
So today I'll be presenting two key insights on two slides, which is central thesis and lessons for investors. First, compounding over brilliance. The most successful companies don't rely on one breakthrough or one lucky moment. Instead, they keep doing again and again basics to consistently to attain sustainable growth, which quotes that compounding to lifts heavy liftings. Second, small edges, big outcomes. Tiny improvements in branding, logistics, and execution may look insignificant in 1 year, but doing it again and again repeatedly gives you outcomes which is more than with widen competitive gaps between leader and competitor. Third, survival before outperformance. So many successful companies protect downside instead of chasing upside, and by removing and avoiding unnecessary and reckless risks. Fourth, discipline in capital allocation. Winning companies always tend to have focus on how they invest, where to invest, and how what the returns they expect, and know that also financial disciplines avoids unnecessary risks. Fifth, focus and simplicity enable execution. So most companies always tend to focus on their core strengths instead of chasing non-core strengths, and involving simplicity in their business, they avoid unnecessary complexities.
moving to next slide, which is lessons for investors. So this slide focuses on four companies with four cases. First is Astral Poly case. Astral Poly got shifted to Brink and faced short-term disruptions due to unnecessary diversification and forex issues. But its underlying business remained intact due to its trust building to its long-term investors. So the lesson is avoid unnecessary diversification. Second case is Asian Paint case. Asian Paint won not only because of its product moat, but because of its core strength lies in dealer relationships. A strong distribution networks provides you with a strong brand recall, loyalty, and repeat demand year after year. So the lesson is sometimes intangible relationships dominates tangible products. Third, HDFC Bank case. HDFC has strong risk management and proper processes, which creates long-term wealth and beats personality. Its great example is Standard Operating Procedure (SOP). Fourth case is Marico case. Marico is a trusted brand which continuously and does small innovations in their product, which creates brand loyalty and predictable cash flows. It also does small right changes at right times, which quotes that big transformation are not necessary for long-term success. Finally, I'll just conclude by giving you key lessons for investors, which is regulatory stability, patience, and business quality gives you long-term returns. So finally, compounding becomes powerful. Thank you. Handing over to Altaf.
Thank you, Mehul. Great investing framework don't start with answers. They start with uncomfortable questions. Let me take you through the final conclusion and a small recap of our journey. The journey behind Unusual Billionaire didn't begin with a market rally, but with a simple and a small observation. That is, some businesses create enormous wealth without leverage, without noise, and without urgency. And that raised a powerful question. If that market reward excitement, why do the quietest businesses survive the longest? To answer this, the research went deep, not into stories or short-term narratives, but into decades of data across multiple sectors, industries. So what emerged was a clear pattern. Yes, in consumer businesses, leaders focus on predictability over scale. In financial institutions, survival was prioritized over aggressive growth. And across sectors, companies stay within their circle of competence and expanded only when returns were protected. Throughout the entire journey, the one insight kept repeating is greatness is not brilliance in one cycle, it is survival for across many cycles. This philosophy shaped a long-term investing framework where time, not emotion, does the heavy lifting. And that brings us to the final lesson. In investing, the biggest risk is not volatility, it is a permanent loss of capital. The business studies didn't win because they were exciting, they won because their discipline was non negotiable. High return on capital, strong cash flow, and conservative balance sheet with ethical management behavior. So the real edge was behavioral, saying no more often than yes, growing only when their capital return were protected, and designing businesses to survive the bad year first. The most powerful takeaway and key lesson for investors, analysts, and individuals is simple. If you remove stupidity, compounding takes care of itself. This is not just a framework for investing, it is a framework for long-term decision making. And this reminds us that in investing, times rewards discipline far more than excitement. With that, we conclude our presentation here. Thank you for joining us.